Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me today, Reema Tendulkar and Hormuz Patakia. Wishing all our viewers a very happy Diwali and festive season as well. And also wishing Hormuz a very, very happy birthday. So double party for all of us at the CNBC-TV18 studios.
Thank you so much. And yes, the party is due. And hopefully the markets are cheering that as well. So yeah, all good. No reasons to complain.
Yes.
Happy birthday to you, G.
Thank you.
Wow.
Thank you.
Back at Hindi again. That's another thing to celebrate.
That's a bigger celebration.
It's looking good, right, for the markets?
Oh, yes, of course. We crossed that 25,900 mark today. We've come up from those levels. But as you said, there's nothing to complain as such. We have the banking index, which continues to be in focus. The mid-cap index doing well as well. So the PSU banking index up 1.7%. We have Nifty infra index, which is up 1%. Private banking index, another 1% there. So all in all, it has been a good start for the week and the festive week as well. Banking index, that continues to be on our radar. It was such a busy week with banking earnings this time.
Oh, indeed. And the Nifty banking index is now up 500 points. But the other big contributor on the way up is Reliance Industries. Yeah. And that is surging close to about 3% on the back of the EBITDA beat, where Reliance Retail did exceedingly well. So those are the two big drivers for the markets right now. But let's get to individual stocks. Hormuz, our birthday boy, has moved over to the big wall and he's putting the spotlight on the top movers.
Thank you very much for all of those wishes. And of course, the banking sector today is been in the spotlight. It was in the spotlight all through Saturday, and it's showing up in the stock price action as well. Take a look at the volumes at which these banking names are trading, particularly the smaller ones. DCB Bank has had 2 crore shares that have already been traded in the first 2 hours. The 20-day average is just 2 lakh shares. RBL Bank more so, of course, for the deal than the results. But still, we have had close to 5.5 crore shares that have been traded. The 20-day average is 50 lakh shares. Federal Bank is 10x of the 20-day average. AU Small Finance Bank is a record high, another 10x of its 20-day average in terms of today's volume action as well. So banking sector names doing fairly well for themselves in today's session. What's not doing well, though, are all of these names, and these are the reactions, the negative reactions. Tejas Networks is down around 8%. UTI AMC has seen a double-digit fall, as has Avantel. Now, you look at the volumes here as well. That Tejas Networks is at 10x of the 20-day average. UTI AMC close to 6 lakh shares traded. The 20-day average is only 23,000 shares, and Avantel too is trading with significantly high volumes. What's also doing well, though, are the tire names after the CEAT results, and CEAT itself is trading with 7 lakh shares traded, the 20-day average being 30,000 shares. And in light of CEAT's results, both JK Tires and Apollo Tires too are seeing healthy gains and with very, very healthy volumes. Back to you guys.
Okay, all right. Thank you so much, Hormuz, for joining in. But let's move on and talk about some earnings now. Tata Technologies posted a mixed set of Q2 earnings, with its revenue growing strong but margin declining due to a one-off cyber incident-related consulting fees. Warren Kevin Harris, who's the MD and CEO at Tata Technologies, is joining us now. Warren, thank you so much for joining in. You know, you had told us growth would pick up sequentially from Q2 onwards. In Q2, constant currency growth of 4.5%. Would you say this performance meets or exceeds the expectations that you had set then?
It's starting to align with the expectations that we had at the start of the year. As you might remember, we were relatively bullish as we came into the fiscal year. President Trump then announced the tariffs. Not only did that affect the US market, but it also had implications in terms of the product plan and the expectations that some of the European OEMs had for the US markets. And so, I think everybody took a pause in the first quarter, and then we started to see clarity come to bear. And against that, decisions have been made that we've been able to intersect with. So we're starting to get back to where we expected to be. And as you confirmed, it was a very solid quarter for us.
Warren, hi. Morning, and thank you very much for joining in. Now, you've called out Q3 as a period of tactical challenges. Can you elaborate what exactly it is that you foresee?
Q3 is always a soft quarter because of the festivals and Christmas. We're rolling out our salary increments from October the 1st for 88% of our employee population. And we're also supporting our customer JLR in the UK as they're grappling with the cybersecurity challenge that has impacted their operations in in September. So those are the headwinds, but they really are, as I've commented, they're tactical, and we certainly do not think that they are going to get in the way of the momentum that we're building.
Interesting. You know, Warren, there was a lot of issues with regards to the cybersecurity incident at JLR. And has there been any impact as such on your company, and will there be any spillover if so?
Well, it had an impact on their entire operations, and so from the perspective of our activities, it was disruptive, but it did not have any financial impact in the second quarter. And right now we're working with the JLR teams to get some visibility in terms of what the disruptions will mean in Q3. And as of right now, we're still working through that.
But what led to the margin decline that we saw in quarter 2 versus quarter 1 this time?
Yeah, we had some one-off expenses that we incurred as a result of the type cyber attack that we were exposed to at the beginning of the calendar year. There were some consulting expenses that we incurred. If you adjust for those one-off expenses, our actual underlying operating margins were 16.4%, which was an improvement upon the first quarter. So not only did we see some sequential improvement in top line, we were also able to translate that into margin improvement.
Okay. Other than the seasonality and the furloughs, are there any other headwinds that you see to the top line in Q3? And what about margins? You spoke about what led to the Q2 margin drop. Will margins further decline in Q3?
We are very, very confident in the context of H2 and the run rate that we expect to take into FY27. But we are still grappling with the issues associated with the disruption at JLR, and so we're not in a position at this point in time to make any commitments with regard to what that particular challenge will mean in the short term and specifically as it relates to Q3.
So Warren, basically you're saying that you have no clarity on how long this disruption associated with JLR take to resolve itself. Is that what you're trying to say?
We are confident because we're in the midst of bringing up their systems as we speak, and so we are very confident the JLR operations will be back to normal fairly soon. But how they then look to recover from the disruption in September is still what we are working with JLR on. And so once we have clarification on that, we'll be able to confirm exactly what that means.
In that case, what happens to your medium-term margins target of, say, 18 to 19 and north of around 20%? Does the margin anticipation get pushed out in the future in that case?
I think we are still expecting and very much planning on getting back to 18% and pursuing the North Star of 20% margins, which has always been our aspiration. And certainly our goal right now is to ensure that our run rate as we end the fiscal year is at that level. Now, whether we achieve that in Q3 or whether we achieve that in Q4 will relate to some of the issues that we referenced before.
But just getting back to that point that you were saying, Q3 tactical challenges, but a solid rebound in Q4. Can you again give some more color? And what is the broader industry looking like? I mean, the global ER&D spending across OEMs?
Absolutely. And, outside of again, the issues we talked about, momentum is continuing to build. And that's what really has excited us about what we've seen in Q2. Our customers are making decisions. The demand environment is much improved, and much of the projects and the product investments that our customers were expected to make at the beginning of the fiscal year, we're now seeing that coming through, and we expect to build upon that in Q3 and in Q4.
But Warren, what about client spending? Are you seeing an improvement on that front, particularly in Europe? And what's the outlook for North America, given that it has remained soft in the last few quarters?
Well, we've seen growth across our three verticals: automotive, aerospace, and industrial heavy machinery, and we've also seen improvement in North America, Europe, and Asia Pacific. You know, Europe has been strong for us in the second quarter, but so too has North America. And I think the disruptions that we've seen since January that were compounded by the tariff announcements in April. You know, I think the uncertainty is starting to dissipate. Everybody's getting now aligned with the new normal, and as a result of that, they are starting to make the decisions again that we expected earlier in the year.
Has the Estec acquisition closed this time?
The Estec acquisition is not yet closed. We've still got regulatory approval in Germany and Morocco to confirm, but we anticipate that in November we'll get that acquisition closed, and so Estec will contribute to the growth story at Tata Technologies from about the December timeframe.
Warren, great chatting with you as always. Wish you all the very best. That is Tata Tech for you. It's an okay quarter. The stock is down close to about 0.6%. They see challenges in Q3, but in Q4, things should get back on the growth trajectory. We'll get into a break. On the other side, we'll invite the management of PNB to talk about their Q2 numbers. Stay tuned.
Welcome back. 160 points higher on the index. Leading the charge are the banking names, and almost every single bank barring ICICI that you can think is trading with gains. Punjab National Bank is also one of them at the highest point of the day, currently 3% higher in response to its quarterly results. Meanwhile, ICICI has slumped to the lows of the day. We are now being joined by the management of PNB. Ashok Chandra, the MD and CEO, is now joining us. Mr. Chandra, good morning. Thank you so much for joining in, and wishing you, your team and your family a very, very happy Diwali and a very prosperous new year as well. You know, start off with your numbers, Mr. Chandra. Your loan growth was a bit lower than what your own guidance was suggesting, and specifically when you see the retail bit, it is impacted as well due to the IBPC. Now, can you tell us exactly what happened during this quarter, and do you see better times ahead in terms of the loan growth in the second half of the financial year?
Thanks for giving this opportunity, and wish you, your entire team, and all the viewers of CNBC TV18 a very happy Diwali. If you see the performance overall in the credit growth also, we have shown a growth of more than 10%. There is a double-digit growth is there. And retail segment, see, we were very mindful of the low-yielding advances and high-yielding advances. And that is the reason you are seeing that there has been some tractions happening in the corporate loan book. But the retail, which we call it as a core retail, that has grown at more than 18%. Agriculture has grown more than 13%. MSME has grown more than 18.6%. Now, if you include all these things with the corporate loan book, because corporate loan book has grown at 7.9%, but the sequential growth in the corporate loan book also, like QOQ, if you see, it is more than 3%. And YOY is also 7.9%, which is higher than the Q1. So if you add all those things, then the entire credit growth, it comes to 10.1%. But excluding that corporate loan book, my entire book has grown more than 15 to 16%. And in fact, in the corporate loan book also, last time also, I had shared some figure that we had 1.36 trillion sanctioned book. It is not the pipeline. This is already sanctioned book. Now that figure has gone up now. It is 1.78 trillion now. And this is already sanctioned book for which we are expecting that the corporates will come forward and they will avail that facility. And disbursements should start Q3, Q4 onwards now. So I think we are well poised for a good growth in the credit segment. And the guidance which we have given at the beginning of this financial year, that is 11 to 12% credit growth will happen at the end of this financial year. I think definitely we are going to reach that goal, and we are going to surpass that figure at the end of the financial year.
Okay, Mr. Chandra, that's about the loan growth. Now, let's come to your net interest margins. Your commentary has indicated that it has bottomed out in terms of the number, but there is an indication that there could be more rate cuts as well. What happens to the net interest margin? What are you targeting? Plus, is there an expectation of that changing once there was one more rate cut that happens?
If you recall our last interaction also after the Q1 result, we had already indicated that the full impact of the 100 basis point repo cut will happen in the Q2. Because 50 basis point rate cut full impact was there in the Q1, and the 50 basis point subsequent which has happened, only 1.5 months was there in the Q2. So full 100 basis point impact has happened in the Q2. And I had already indicated in the last time also that Q1 and Q2, definitely there will be a shrink in the NIM. But if you see the impact which has happened, if you see the YOY also and QOQ also, I think it is a very, very muted, the negativity has happened. Like 2.84% was our domestic NIM in the Q1, and this quarter it is 2.72%. Going forward, because we all know that whenever the repo rate cut happens, we are passing this entire thing immediately on the next working days. And when the 49% of my book is priced on the repo rate and EBLR, I think we have passed all those benefits to the clients now. And the same thing doesn't happen in the deposit side, because there is a lag in passing that the reduced interest rate benefit, interest rate to the customers, and that takes some time. And there were some deposits we had a special scheme of 400 days deposit where we were paying 7.25% and 7.75% at senior citizen. So all those things are getting repriced now. And like last time, I have already indicated, and I am holding to that view, that Q3 and Q4, definitely there will be some improvement. I'm expecting that at least 5 to 7 basis point improvement will happen in the NIM in Q3, and around 10 to 15 basis point improvement will happen in Q4.
Okay, 5 to 7 basis points NIM improvement in Q3 and 10 to 15 going ahead. The other thing is your credit cost. While you have lowered the guidance while moving from FY25 to FY26, and even this quarter you've reported a negative credit cost, will it sustain? And what is the guidance, sir, you can give on your gross NPAs?
Yeah, see the credit cost in the first quarter itself, it was 0.14%. And the guidance which we are given for the full year is below 0.50%. This quarter, it is almost at the bottom, rather it is negative now, 0.2622%. We are still holding that our credit cost will be really very small number will be there. The guidance of 0.50, definitely we will be far below that number. Reason is that we have almost a 97% PCR. Exact number is 96.91%. And this quarter also, if you see, there has been further improvement in the PCR. Despite having negative credit cost, we have improved in the PCR. And absolute number in the net NPA, that has also come down now. So we have made some provision in this particular quarter also. Despite making a provision, since there was a good write back of provision was there, and we have a very good slippages management. I think that is also playing very important role. Like in this particular quarter, our slippages was only 1,900 crore compared to last year it was 2,200 crore. So slippages management and the good recovery, I think that is playing important role in the credit cost. As far as the gross NPA is concerned, if you see the drastic improvement has already happened now, and we are at 3.45%, and the guidance for the full year is below 3%. I think definitely we are going to achieve that guidance. And when the net NPA also, 0.35% we have given the guidance, and we are at 0.38. So we are all well above the guidance which we have given, and definitely there will be significant improvement in the asset quality, and all the parameters related with the NPA management will be there.
Mr. Chandra, there are lots of questions, but I'll sneak in a quick one on PNB Housing as well. The hunt for the new CEO. Where has that process reached? And part two, will it be an internal candidate, or are you zeroing in on an external candidate as well?
See, in my last conversation, I had made it very clear that there will not be any internal candidate from PNB to the PNB Housing. And still, I am holding to my view on that. As far as the process is concerned, I think you have seen that very transparent process was initiated by PNB Housing Finance Limited. We are one of the promoters, but we maintain a very arm's length distance for all the process, which is being conducted by the PNB Housing Finance Limited. I am also expecting that very soon the final outcome will come and we will have a new MD and CEO in PNB HFL.
How soon is very soon, Mr. Chandra? If you could share a timeline, sir.
See, there are certain processes are there because they have to finalize the name, then NRC and the board, they have to give the approval. And then finally it goes to RBI. Once the RBI approval comes, I think then only it will be in the public domain and then only it will be known to everybody.
All right, take that point, Mr. Chandra. Thank you so much for joining in today with your insights and the outlook about bank's performance going forward. With that, we'll slip into a short break. When we come back, we'll get you more on the markets on the other side.
Welcome back. One stock which is under severe pressure today is Tejas Networks. This is a company which manufactures telecom equipment. It participates in the entire ecosystem. They get a lot of revenues from the BSNL contract, setting up networking sites for them. Came out with numbers over the weekend, disappointing said. The company reported a loss for the third consecutive quarter, and the loss in Q2 was close to about 300 crore rupees. And the company said that, one, the revenues were lower, although they did, there was a delay in the shipment of orders from BSNL. So they got a purchase order, but the actual, it wasn't implemented. So that resulted in the loss. But secondly, there were also provisions due to manufacturing process losses, some warranty, inventory obsolescence, and that was to the tune of 190 crore rupees. So out of the 300 crore loss, 190 was on account of that. So the street is quite disappointed. And the stock itself is down 7%. And from the start of the year, it's seen a cut of close to about 55%, I think. So this has been one bit of a big miss.
One of the worst performing stocks, right, on the small cap index has been Tejas Networks, 8% lower. By the way, you can't take your eyes off the smaller banks, and two of them stand out. We just spoke of DCB Bank, 15% higher on that stock. But South Indian Bank, results came out last week. The stock is up 17%. It was not one of the blowout quarters that we spoke to the management as well on Friday. That stock is up 17% now. But the Nifty still holding on to levels of 25,850. What is the FNO data indicating? Mangalam joins in now from the FNO desk. Mangalam.
Well, the Diwali dhamaka continues for the frontline index. In fact, if you look at it, the Nifty led higher by the Nifty Bank. All the other indices also contributing to it. The mid-cap index not gaining as much as the frontline index, but not underperforming as much as we saw on Friday as well. And a large part of that is on account of FII short covering. So if you look at the FII long exposure over the last 4 trading sessions, that's increased from 7% all the way up to 17%, telling you some of the shorts have been caught on the wrong side, and they've covered nearly 50,000 contracts. So that's boding well for the frontline index. What's doing even better today is that we have contribution from the top heavyweights. We have Reliance, which is doing extremely well. The Nifty Bank is performing well, as well as the Nifty IT index. So all of them putting their foot forward and supporting the frontline index, though the advanced decline ratio could have been a slightly better one as compared to the others. So that's something we will monitor as we move towards today's trading session. The important part is today is also the weekly options expiry on account of tomorrow being a Muhurat day trading. So the 25,800 put and the 25,900 put writers fairly active, telling you between 25,750 to around 25,850 there is support for the frontline index where we are at right now. However, as we move higher, closer to 25,900 and perhaps 26,000 as well, which is where the psychological resistance comes in. That's a mark that we need to contend with, at least for today's trading session. So between 25,950 to 26,000, there could be some sort of supply that may emanate. But a lot of these smaller banks you guys spoke about, AU Small Finance Bank, Indian Bank, seeing a lot of long positions being added. Axis Bank also fairly well bid in today's trading session. But just watch out for RBL Bank, because the shots have been squeezed out there. The stock entering into the deal news was in the F&O ban. It may exit F&O ban today. And were that to happen, we'll see an impact on that in tomorrow and thereafter the other trading sessions as well. So far, very good going for the markets. 25,950 to 26,000 may see some supply.
All right, take that point. Thank you so much, Mangam, for joining us with that F&O setup. Let's take a short break now. When we come back, we'll put focus on Reliance Industries earnings and the banking sector as well, both of them buzzing in trade. Welcome back. You're still tuned into Trading Hour. One of the big movers in the market, which is supporting Nifty's gains, is Reliance Industries. Reported numbers on Friday post-market hours, and it was a strong set led by the beat that we saw in the retail business, oil to chemicals business, and also their digital services business. If you look at the consolidated numbers, the EBITDA was at a 6-quarter high, came in at 45,885 crore rupees, which is higher both on a quarter-on-quarter and on a YOY basis. Their net profit at 18,165 crore rupees is higher on a YOY basis, lower quarter-on-quarter, but do remember there was an element of stake sale in Asian Paints that led to higher other income in the quarter gone by. But Reliance Retail, that was the big driver. The growth came in at 18.6% versus estimates of 13 to 15%. Geo EBITDA growth came in at 17.5%. That was led by higher revenues and also 240 basis points YOY margin expansion to 56.1%. Brokerages, they are quite sanguine on the stock now. Nomura says they have a buy with a target price of 1,700 rupees a share. They've raised their FY26 and FY27 EBITDA estimates by 4 and 12%. Morgan Stanley says that they have an overweight rating. Reliance Industries earnings now should get the investor confidence back. There's a re-rating ahead as the consumer retail is turning around and beating estimates as well. JP Morgan has an overweight with a target price of 16.95 on the stock. They say quarter 2 was operationally better and this growth should sustain in the long term, and that's why they are also very positive on this name.
Indeed. Fourth best day of 2025 is what Reliance is having currently. Almost 3.25% higher on the stock, single-handedly taking the Nifty higher, even as the other two major constituents, HDFC Bank and ICICI Bank, have cooled off from their respective highs. In fact, ICICI Bank is now at the lowest point of the day. And staying with banks, this whole bunch of earnings that came in after market hours on Friday and over the weekend have proven that why the Nifty Bank was the first one to reach fresh all-time highs. Lata is now joining in with her editor's take on how the narrative for the entire banking sector has now changed.
Well, to start with the micros, the margins reported by banks has completely beaten analyst expectations. ICICI actually reported, let me start with the biggest. ICICI reported 4 basis points fall in margins. But actually, that was because the previous quarter, they had an income tax gain. You know, the base was higher. If you adjust for the base, actually, ICICI has reported a rise in margins by 3 basis points if you compare like to like. And then Federal, AU Small Finance, DCB, IOB, IDBI, a bunch of them have reported higher margins. Now, that's not easy when repo rate gets cut by a full 100 basis points. That shows excellent management of deposits and of assets. So overall, they've repriced very sensibly, the banks, and very nimbly. HDFC Bank, the big one, that was the one that was keeping the bank Nifty under the weather. That has kept its word on loan growth. You know, for 2 years, they were in mid-single-digit loan growth. They promised that in FY26, we will grow along with the industry. FY27, we will grow faster than the industry. They have kept their word as far as the first promise comes. And it's not easy, you know, when you're a 27 lakh crore bank, to control loans when you want, to let it grow when you want, to allow deposits to, you know, grow exponentially when you want. That's huge. They have eaten up a 7 lakh crore asset book of HDFC, and in just 2 years they are back to industry standards. So, you know, the point is, one shouldn't be surprised that the Bank Nifty is the first one to go to all-time highs and not the Nifty. And that is for a bunch of reasons. One, this year, the Nifty EPS may be 12-13%, but bank EPS, if you take the big banks' EPS, it's likely to be an 18%, even a 20% EPS growth. Secondly, NIMs. NIMs have improved much faster than the industry expected. And now, even with one more rate cut, if they can manage 4 rate cuts, what is one more? They will be able to grow their margins. Credit growth, which was really under the weather in the previous 4 quarters, is likely to take off. The GST boom is only going to help this credit growth. CRR advantages are yet to flow because it was in the latter part of September that the first CRR cut comes in. So that advantage will also come. FPIs are seriously underweight, even in the MSCI India index, EM index. So once they come in, the banks are the big weight in that index. So you are going to see a serious flow into banking stocks. The important point to note is the narrative change. 1 year ago, everyone was saying, they're losing their savings to mutual funds. Now banks are, the best period of banks is over. Look at the way the narrative has changed. They're better on margins, better on loan growth. If volume and margins are both better, you are going to see, a good period of earnings growth and ROE growth. And finally, it is this purchase of stake by NBD in RBL and SMBC in Yes Bank. It is telling us that a huge door is opening of foreign capital coming in. Never mind if the European banks are too weak after the Credit Suisse fall and the American banks like Citi and all have been selling off their retail assets. There is a whole new world opening up in terms of Japan and Middle East, which is rushing in, and private equity capital. Federal Bank is going to announce something very soon. So private equity also rushing in. My sense is that Bank Nifty is going to be able to pull the Nifty to new highs and lend its weight in a very big way in the days to come.
Well explained. Thank you, Lata, for providing that editorial perspective. We will slip into a break on that note. On the other side, more on the market. Stay tuned. Welcome back. Let's get to the big story of the day, and it's none other than RBL Bank after Emirates NBD's deal with RBL Bank. First, Gaurav is here to take us through the details.
Well, yes, when we look at the RBL Bank, we have already seen the stock has ran up, and let me give you why, the reason why. When we look at result, it was not that great. In fact, profit declined almost by 20%, but there was another lever which is actually pulling the stock, which is Emirates NBD is going to now invest around 26,853 crores in the bank. This will be invested to get 60% stake in the bank. Remember, this is the largest FDI investment in the Indian financial segment, and also it is also the first acquisition of the majority interest in the profitable Indian bank by a foreign bank. After this deal, definitely it will trigger an open offer, and Emirates NBD will make a mandatory open offer to acquire another 26% at a price of around 280 rupees per share. When we look at the overall transaction, the board of director of Emirates NBD and RBL Bank, they have approved for the amalgamation of the branches of both the banks, and at the same time, after completion of this 60% stake acquisition, Emirates NBD will be designated as the promoter of the bank, and at the same time, they will also have rights to nominate director of the board, subject to regulatory approvals, of course. The benefits, if we have to highlight a few, first is that this infusion will increase the net worth almost by 3 times. Currently, it stands at around 15,000 odd crores. It will increase to more than 42,000 crores. Apart from that, this will also mark the beginning of the bank's next growth chapter. It will be stronger, more diversified, and future ready as per management. Now, the next date that you should be watching out for is the 12th of November, because that is the date when EGM will happen, where bank will seek shareholders' approval. And from here on, management is also very optimistic about it. In fact, they indicated that Emirates NBD currently runs at around 19 to 20% of the ROE. So they are also hopeful to reach that level. Remember, currently the bank has ROE of around 5 to 6%. We also got a chance to catch up with the management. So let's also hear to what they had to say about the deal from here.
I feel that with the current trending and the core value which we are likely to create with this deal, I don't think that the people will be looking at responding to the open offer, because it is going to be something which co-creation of the value. And this huge investment which is coming into the bank will also improve the book value also. Yes. When the book value moves up, this is something which is going to add up to your market value. Market cap will go up. So taking all these considerations, I feel, I mean, it's just, open offer may not kick in much of the numbers, and it will be hovering around 60 plus the branch merger, whatever the percentage is going to come. Immediately it is going to be the RBL to start with, and we have to wait for the things to evolve rather than taking a preemptive thought in that. Today my capital adequacy is, CRAR is around 15%. 15. For the discussion purpose of understanding, but let us hold it there. Yeah. Right? In the expanded capital of 42,000, I am going to maintain that as a set aside for the purpose of regulatory capital. So somewhere around 6,000 crores or something like will be set aside. So the remaining around 35,000 crores is something is going to be available for us to expand the business, taking some investment part of it and other things, and a conservative of around 8 times because some of the will go for distribution investment and things like that, technology upgradation and things like that. Leaving those aside, possibly the very rough calculation will make us 8 times if I do it, and it has an ability to grow the asset to the tune of around 2.5 lakh crores. This is something which is a big opportunity. This is not a one year story, it's a 3 to 5 year story what we have been thinking among ourselves. However, the deeper calculations are required to be done, and will work much better. I strongly believe this is going to get our credit rating revised. We are now AA minus, and naturally this synergy is going to be you are strongly capitalized, your future growth is assured, and you have bigger opportunity to make the better things, and there will be positive rating upgrade for the bank is concerned. There is every possibility. See, today our ROA, we are intend to reach around 1% exit ROA with the current setup. So when you are going to get such a huge influx of the fund, the capital, which is interest-free, that is automatically going to kick up my ROA maybe around 0.5%, 0.7%, depending on exact calculation we have to do that. So my ROA by design will go up because of this capital infusion. The next 2 to 3 years, with an accelerated growth, what we are looking at, an accelerated path we are looking at, then it will be in a position to come back to its double digit maybe in another 2 to 3 years' time.
RBL Bank 8% higher on the stock after that mega deal announcement from one banking stock to another, possibly the stock of the morning if you could call it that. DCB Bank 15% higher now after its results. The second quarter, good one. Credit costs were down, the margins expanded. Mr. Praveen Kutty, the managing director and the CEO of DCB Bank, is now joining in. Mr. Kutty, good morning. Thank you so much for joining in, and wishing you, your team, your family a very happy Diwali. First up, your credit costs have seen a significant improvement.
Thank you for having me here.
Your credit costs, they have seen a very significant improvement, right, from the previous base quarter. Do you see that trend improving? Was there a one-off that led to this improvement in credit costs, or do you see this trend being normalized in the second half as well? Where do you see them by the end of the year?
So what we are seeing now is a series of quarters where our growth has been consistent. And last quarter, our credit cost was 0.59%. And I had said that at that point itself, that's a one-off. We are being prudent, and we are taking up increased provision for the unsecured portion in our books, primarily comprising of MFIs. Now that's done, we are back to normal. And I remember telling you last time itself that for the full year, we would be less than 0.45. And if you were to look at the last half year, the current 31 bips credit cost and the previous quarter 59 bips credit cost, we are still at the 45 bips mark. And my guess is that we will end the year in the early 40s, if not 40.
Okay, that's about the credit cost. There's been an improvement in net interest margin as well, to the tune of 3 basis points. How will NIM shape up from here on? It'll reach that 3.5% mark by FY26?
The way I see this is that across the bank, over the last 5-6 quarters, we have gone ahead and tightened our belt. And that's true in cost of deposit, that is true in cost of borrowing, that is true in cost, OPEX by itself, and we'll talk about that at some point in time. I really felt that we were leaving too much on the table on multiple parameters, but we've significantly tightened stuff. And the repo rate cut, a 100 basis point repo rate cut, has been a blessing in disguise because it helped us cut the flab, make us leaner, look at every opportunity of cutting flab. And I think we're seeing the beginnings of that. The bank has grown 19% on deposit, 18.79% on deposit YOY, with a much tighter cost of deposit coming through. And that is a change not only for the quarter, but I wouldn't say it's cultural yet, but if you see 2 or 3 more quarters of a similar kind of growth coming in with similar kind of tight cost of funds coming through, then possibly we have a good thing going in the future. But I can confidently say that the NIMs have, the bottoming out of the NIM has happened. So from here on, unless there's another rate cut, we would tend to see a NIM expansion happening.
And unless there is a rate cut, what could be the extent of NIM expansion over the next 2 quarters? You're at 3.26, I think, now.
So we're at 3.23 right now, which is at 3 basis points higher than the last quarter. I'll tell you how it works. Our term deposit usually is of a 15-month duration. So with every passing month, the deposits that we have booked 14, 15, 13 months back is coming up for renewal, and you're getting the benefit of a significant amount of benefit because the new term deposits are being priced at a much lower rate than the old one. So even if you were to our renewal ratios continue to be as it is, and there is, let's assume there's no improvement, we would see a significant decrease in our cost of deposit by virtually doing nothing, just by renewing our existing deposits.
Now, Mr. Kutty, your cost to income ratio, it's inched up slightly during this quarter. If you could shed some more light on that. And is it only because of the lower base on the back of some muted other income? Do you believe that this will normalize in the second half?
I look more at cost to average assets than I look at cost to income. But since you asked about cost to income, it's pertinent to point out that between Q1 of this year and Q1 of last year, we shaved off 700 bips in last Q1. And in this Q1, where there's been an uptick and we are at 61% plus, we have shaved off 300 basis points. So if you were to compare it where we were 12 months back and now, both across Q1 and Q2, there has been a significant cutting down in cost to income ratio. Now let's look at cost to average assets for a change. It was 2.75 5 quarters back, went down to 2.65, 2.54, 2.52, and now we're at 2.43. And this is like consecutive. Every consecutive quarter, we've been lesser than the previous quarter. So we shaved off 32 basis points on cost to average assets in the last 5 quarters and last 5 successive quarters. So that's a trend. That's not a one-off. And that's why I said there is a bit more of fiscal discipline. There's a bit of tightening of belt across the various units of the bank. Yields have gone up, have been tightened. We have let go of borrowings which are expensive. We have let go of investments which are poor returns. And on OPEX, we have seen that we have reduced 1,118 people in this year from last year to now, and we've still grown 19%. And you also see that technology adoption has been significantly higher, which is helping us in our OPEX cost. So these are not one-offs. These are I would tend to think these are cultural shifts. These are tech adoptions, and that would keep the bank in good stead in the coming days. We haven't seen the full impact of all we have done so far. We just scratched the surface. Much more to come.
Got it. Mr. Kutty, last question before we let you go. Quickly, if you can tell us what is the target on loan growth and which segments are driving loan growth for you?
Yeah. So we want to keep it between 18 to 20% growth, which is the way we've been growing for the last 5 quarters. You would see similar kind of growth happening. The sectors, frankly, nothing new. SME is a very important component. Mortgages is important. Within mortgages, LAP will overshadow home loans. You see gold loan, organic gold loan increasing as we go along. The only area where you would perhaps find a reduction in a percentage terms would be co-lending. Q4, you would you'd find that our co-lending ratios will come down. We are at 16% plus currently. By the time the financial year ends, it will be 15% or less. But except for that, I think every other asset category, you would see the normal kind of growth that you've been seeing for the last 4-5 quarters continuing.
Thank you very much for that. That is DCB Bank guiding for an 18 to 20% loan growth. They expect the NIMs to improve from here on in Q3 and Q4 unless there is a rate cut. So the management categorically saying they have bottomed out. And even the credit cost, which in the first half of the year was 45 basis points, towards the end of the year, it could end closer to 40 basis points or between 40 and 45 basis points. I think that explains why the stock is up nearly 15%. Get into a break. On the other side, we'll focus on the crypto market. Manisha Gupta joins in.
Coin DCX.
Shifting focus now to the crypto space, Manisha Gupta joins in as promised. Manisha.
Well, in Crypto Corner today, we talk about the last 1 year that has been in sense of crypto from Diwali to Diwali. So when you look at the price moves, those have been clearly very, very assuring. If you look at Bitcoin, we've seen 64% of gains. Ether is up 52%. Good gains coming in for Cardano and Binance as well, with nearly 84 to 89%. But the outperformance comes in from Ripple with 345% of gains in last 1 year when you look at many of these crypto prices. The last 1 year has been quite productive and newsy and eventful as well when it comes to crypto. To begin with, Bitcoin marked yet another record high in this year at around $125,000 therein. If you look at the evolution of Web3, decentralized finance, stable coins, we saw a lot happening in this space as well in various geographies. There also was an approval of spot Bitcoin exchange. You don't have to go for a case-to-case. Now you can just file, especially when it comes to US. And the total product inflows have crossed $50 billion just in this space itself. The institutional framework investment demand has been quite on the stronger side as well. Various corporates, banks are now moving in to include crypto within their treasuries, also enabling or facilitating crypto movement, price movements as well in sense of a trading desk for their wealthy and institutional investors also. And then the street also has seen strong regulatory developments, government interference as well when it comes to US especially, and then various countries in Asia and Europe. The markets also are looking at network upgrades and activities within as well. The expansion of real-world asset classes, including traditional assets like real estate, securities, commodities, which are now being tokenized on-chain, also saw a huge growth here. It also has been about major advances in layer 2 scaling solutions that we saw come in from Polygon, Ethereum in various ways as well, and Solana also for that matter. There also is growth in BaaS, which is blockchain as a service. Adoption from various tech companies, whether it was Google or Alphabet, we saw various strong numbers come in from there. And then blockchain as a supply chain and healthcare also made inroads in various countries, including India as well for that matter. Finally, it was about improved interoperability, whether it was between the blockchains or within countries and cross borders. It also has to do with the AI integration that we saw strongly take over when it comes to blockchain and cryptos. That has been quite positive as well. I mean, these are just a few that we have seen in sense of development and growth, scalability even in the last 1 year.
Thank you, Manisha, for joining us with that update from the crypto market. With that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime report comes up next with all the market action.